Something strange has been happening to the money supply, because for about a year and a half, the total money supply was constantly decreasing, and the rate at which the money supply was contracting was echoing recessions and depressions of the past. But during the last couple of months of 2023 and the first few months of 2024, the decline in the money supply has reversed and begun to grow yet again. This is something most people have not caught on to, simply because of the fact that a decline in the money supply is actually so rare in recent US history that it's been gaining all the attention recently. If we look back since the 1980s, we have never seen a time in which the money supply contracted until April of 2022. In fact, we have to go all the way back to 1948 before we see a brief contraction of the money supply, and before that, a contraction in the money supply was quite common. But for months now, the money supply has actually been increasing again. The question is why? Well, we can see that this recent re-expansion of the money supply has started to impact prices. Month over month, inflation in consumer prices have started to increase at a faster pace than expected, with year-over-year inflation in January of 2024 at 3.1%, which was higher than what people expected at 2.9%. This means the rate at which prices have been increasing on average hasn't really changed since June of 2023. And again, this doesn't mean that prices are not changing. This means that prices are going up at a consistent pace, a little over 3%, which is odd considering the money supply wasn't actually going up until the very end of 2023. We have a ton of puzzle pieces that we're gonna need to put together here, so let's start off with what actually causes a change in the level of prices. There are many things that contribute to prices, but you can think of prices as information regarding the ultimate scarcity or abundance of something relative to everything else. For instance, if half of the wheat crop in the world are wiped out tomorrow, then we know that the price of bread will probably go up because we can't make as much bread as we used to because there's less wheat. The prices will go up until we find a new equilibrium point at which people are willing to pay the higher prices and some people are not willing to pay the higher prices, so they don't buy. Ultimately, the prices communicate that information and it lets people make decisions about whether they're going to continue consuming something or not. We only have half the wheat, so we can only consume half the wheat because you can only consume something that has been produced. Prices going up are the most fair, most efficient, and most effective way to decide how that increased scarcity will be allocated. But obviously we don't live in a completely free market. In fact, most things that we buy and sell on a regular basis have other things influencing their price other than just free market scarcity or abundance. Things like regulations, taxes, tariffs, subsidies are all influencing whether something is artificially higher in its price or artificially lower in its price. As an example, when our US government decides to send hundreds of billions of dollars to a foreign country for a war, and they turn around and spend that money on arms manufacturers here in the United States, those arms manufacturers then increase the scarcity by taking some supply of things like steel, aluminum, gasoline, oil, plastics, and rubber, electronics, and they ship those off to the foreign countries just to be exploded and destroyed, thereby increasing the scarcity of those items and materials for everybody else, increasing the price. And so all across the world, we have inflationary forces that are pushing up the price of things by soaking up some of the abundance, by increasing their scarcity. But obviously we have the money supply as one of the largest factors that contributes to inflation or deflation. This is why despite technological advancements and innovations over the past decades, we've seen the cost of living continually rise because the amount of money in circulation continues to rise. But that all changed in April of 2022. After a historic increase in the rise of the money supply, the Federal Reserve caught religion and started to try to decrease the money supply for the first time in recent history. We can see that they were successful with it for about 1 year from April of 2022 until about May of 2023, and then the money supply started to move sideways. Real quick, I want to let you guys know that in just under 2 weeks from today, I'm going to be hosting a completely free live online event. It's going to be a webinar covering how all of this fits together. We'll be discussing how the Federal Reserve will try and fail at putting a lid on inflation as soon as the economy starts to break, and how what the federal government is doing is actually pushing the financial system closer towards something breaking. We'll talk about the overall context, how this fits into the long-term debt cycle, because we've seen these things play out many times throughout history. There's a pattern at play here, and it's playing out again today. And obviously, above all, we're going to be talking about how to actually profit from all this. The event is going to be on Thursday, March 7th, and spots are actually limited. I know people always say that, but it's actually a Zoom limitation on the webinars. There's only 500 slots, and they're already starting to fill up. So if you're interested in joining, go to the link below, sign up now. See you there. So the question is, how does the Federal Reserve do this? Well, now we're looking at a chart of the Federal Reserve's balance sheet, and this is their main tool for affecting the money supply. When their balance sheet is increasing, it means they are printing money to buy assets from banks. And then those banks can, if they want, to turn around and buy other assets from other people like the United States government. This is called quantitative easing or debt monetization. It's where the central bank creates new money out of thin air to buy assets out of the economy, and in place of those assets, they insert cash. Then those financial institutions that they gave the cash to for those assets had the freedom to turn around and do something else with them, which is usually just make new loans. They buy new assets instead. So while the Federal Reserve's balance sheet is going up, this is creating the opportunity for more cash, more liquidity in the economy. This also means that when the Federal Reserve's balance sheet is declining, the opposite is happening. When the Fed's balance sheet is declining, that means they're letting some of that debt get paid back to them, and they're not rolling it all over. It means they're not taking that cash and loaning it all back out again. Some of that debt is actually retiring, which means the amount of dollars, the money in the system, is actually shrinking. Of course, I'm not saying that that's the exact net result, because there are other factors that affect the money supply we'll get into. I'm just saying that if everything else was equal, and if the only thing happening was the Fed's balance sheet, then yes, the money supply would be shrinking. And so for a while, from May of 2022 up until about May of 2023, the Fed's balance sheet contraction was effective at shrinking the money supply. But even though they continued to shrink their balance sheet from there, it did not have the same effect on the money supply. And that's where we get to the next piece of this puzzle, which is the reverse repo facility. The reverse repo facility, you can see, has been declining since about May of 2023, and it has gone from a level of about $2.3 trillion down to about $493 billion. I've made quite a few videos explaining what this facility is, but essentially this is just where a bunch of excess cash is sitting because it's getting paid an interest rate by the Fed. Mostly money markets have placed their cash with the Fed in this reverse repo facility because it's a risk-free return. The reason that it's declining is because the federal government is now offering T-bills, which is short-term debt, at higher and higher rates. So it makes sense to take some of the money out and loan it to the government with T-bills instead because it's a higher return. As the government borrows more and more at the short term, it will draw more and more money out of the reverse repo facility. This is why the money supply stopped shrinking for the last couple of months, because all the money that was in the reverse repo facility was not technically in circulation. It's not counted in M2. So as the reverse repo facility started to drain, the money supply started to flatline. The Fed was still trying to do their job of shrinking the money supply by shrinking their balance sheet, but money into the reverse repo facility was getting pulled back into circulation by government borrowing. And that had a stabilizing effect on the money supply, and so the money supply stopped shrinking. So the Fed was trying to pull money out of circulation with quantitative tightening, but more money was getting pulled into circulation by the government borrowing. The result was the money supply stayed relatively flat. And since we have more things than just the money supply impacting inflation, well, that's why we saw the rate of inflation flatline as well. Because we still have inflationary forces, but we no longer have the offsetting force of money getting pulled out of circulation. So prices still rising, now at a very consistent pace. So what in the world is this all about then? Over the last couple of months, the money supply is starting to rise again, especially considering the drop in the reverse repo facility has started to flatline. Well, if we take a closer look at the Federal Reserve's balance sheet, we can see that the amount that it's decreasing by has actually started to flatline as well. It can be kind of hard to see this on the normal chart, so I've changed the chart now to show the percentage change on a monthly basis. And you can see that recently this line has started to curve upwards, which means the amount their balance sheet is declining by is a slower and slower pace. Okay, so that piece makes sense. We are seeing the balance sheet decline at a slower and slower pace, which means they're not sucking as much money out of circulation as they were before. But there's another piece to this puzzle, and that's government borrowing. This is a chart called the Treasury General Account. This is the US government's checking account. And you can see that over the last couple of months, the amount of money they have in their checking account has basically stayed flat at around the $800 billion level. This means that they are spending roughly the exact exact same amount of money as they are bringing in. Their checking account isn't increasing on net, it's not decreasing on net. We can also take a look a little bit deeper and see that when we look at their tax receipts, meaning the money they take in taxes versus the amount of money that they are spending, those two lines are converging recently. So over the last couple of months, the US government has actually been spending a little bit less, and the amount of money they've been receiving in taxes, or I should say taking in taxes, has been increasing. And this is why we see a flat line in the reverse repo facility that was decreasing at a very consistent pace and has recently stopped decreasing as quickly. Essentially, over the last couple of months, the deficit has shrunk. This is temporary, but it has shrunk. The amount of money the government takes in taxes is right now very similar to the amount of money it's spending. And they're not borrowing any extra on net right now, so the amount that they have in their checking account is also staying roughly the same. This explains why when we look at interest rates on short-term government debt, we can see that the interest rate has been fairly consistent over the last couple of months. Okay, so now it looks like we have a couple pieces of conflicting data here. The money supply is increasing. Part of that is because the Federal Reserve has stopped trying to decrease the money supply as much as they were before. But at the same time, we also have less government borrowing right now, just for a very short period of time. It won't stay this way forever, but for right now, less government borrowing. So where is this increase in the money supply coming from? And that's where we get the last piece of this puzzle, and that is bank lending. In normal environments, bank lending continues to trend higher and higher. During the financial crisis, we had a big drop off in bank lending that started to rebound in 2011. And in 2020, we had a decrease in government lending that started to rebound again in 2021. And while the course of 2023 did see somewhat of a slowdown in bank lending, that has recently started to tick up higher. If you are not aware how bank lending works, it is loaning money into circulation. If you put $100 in your bank account, they're going to take 99 of those dollars and make a loan with those dollars. As soon as they make a loan, those $99 get deposited into somebody else's bank account. And then that new bank takes that $99 and they loan out 98 of those dollars. And those $98 land in somebody else's bank account. And then that bank takes 97 of those dollars and loans them out again. This means that for every original dollar in the banking system, if you can even call it that, ends up being $10 or even $100 throughout the banking system in various bank accounts. The more loans that are created, the more dollars exist in the system. And because bank lending is starting to increase yet again, at a time period where the Federal Reserve is not decreasing their balance sheet as quickly as they used to, means that we are seeing a new increase in the money supply, explaining the sticky inflation that we are unfortunately continuing to see. So what does this mean moving forward? Well, the lull in deficit spending is likely extremely temporary. It's a seasonal thing, and this year is going to see a massive rollover in government debt. I made a video about that last week if you haven't seen it, which means more government borrowing, higher rates, and higher inflation. We are likely to see unexpected consequences this year as a result of trying to centrally plan an economy. Nobody expected the money supply to decline for the first time since 1948 like it has during recessions and depressions of the past. Similarly, nobody expected the money supply to start to increase again at the end of 2023. On top of all that, nobody expected that interest rates would stay this high for this long and that the market would actually stop pricing in rate cuts. Yet here we are. It's not so much that they're kicking the can down the road, it's more that they're pushing a snowball down a snowy hill. The problem continues to get bigger and bigger until it becomes so big that they cannot stop it. Fortunately for you and I, we don't have to be vulnerable to the crashes and the consequences of their poor planning. With proper financial education, we can not only be protected against these crazy market times, but we can also profit from it. If you haven't already joined Heresy Financial University to do just that, you're missing out. I invite you to join. Link is in the description below. As always, thank you so much for watching. Have a great day.